Friends, you are welcome to my YouTube channel AKD Global Education. Today I shall discuss some facets of debt management with respect to personal finance. Video is going to be very interesting and important one. Don't skip and watch till end. Why and when debt or loan is required in managing personal finance. Debt is used to finance goals when available funds means self-funding are inadequate. Even though income might be higher than expenses, it is not possible to finance every purchase or asset with just existing savings. For example, most people cannot buy a house without a loan as cost of house is huge. It is likely to wait till retirement if anybody would like to buy a house through self-funding. The debt is called home loan. Lenders protect themselves by securing their loan against a charge or pledge or mortgage on the property. Such loans are called mortgages. Other debt includes auto loans, credit taken for buying consumer durables, personal loans, and credit card outstanding. But debt comes at a cost and imposes repayment obligation on the borrower. The decision on whether or not to use debt depends upon ability of the available income to bear the additional charge of interest and repayment. Debt is not always bad. In some cases, the decision to use borrowed funds over owned funds, also called financial leverage, may actually increase the return made on the investment. In some cases, a loan may be better choice than drawing from retirement account to fund children's education. On employment after completing education, the future income would be easily able to repay the loan. Now I shall discuss impact of debt in cash flow management. Why some debt is good and may even be recommended, but how much debt is good depends upon the financial situation of each household. A good indicator is the debt to income ratio, that is DTI, that measures the ability to meet the obligation arising from debt with available resources. Lenders set their own limits on how low your DTI must for loan approval. Low DTI shall help to get loan. Generally, DTI more than 40% is seen as high. It affects the ability to meet other regular expenses, provide fund for emergencies, and possibly nothing left to invest for future. The interest rate and amount of debt play an important role as far as measurement of impact of the debt concerned. Higher interest rate will increase the repayment amount. One has to look at the cash flow to decide the amount of loan to be taken so that cash flow management plan is not disrupted. Now I shall discuss consumption expenditure and investment expenditure. Many of us have an endless list of lifestyle expenses, but resources mean income is limited, so you have to be judicious in spending. All expenditures could be classified into consumption expenditure and investment expenditure. Consumption expenditure is that amount which once used does not create any assets that generates further income. Amounts spent in restaurant, or buying clothes, or expenses made at saloon are some examples of consumption expenditure. On the other hand, investment expenditure will lead to creation of an asset which then can generate further income in future. For example, buying a property or bonds are investment expenditure. Some outflows, like providing education to children, may appear to be consumption expenditure, but they may be a useful investment if the children do well and are able to raise families' income. Investment expenditures need to be prioritized. Aim should be to allocate funds for savings before considering the discretionary expenses. Now I shall discuss some aspects to be considered prior to loan plan. First, I shall discuss factors with respect to purpose of debt. Debt or loan should ideally be taken for acquiring appreciating assets such as real estate. Education loan may be taken to upskill. This will enhance family income in long run. Loans should not be taken for financing risky or volatile investment propositions like margin trading in stock market. Loans should not be taken to finance one's regular expenses. Taking short-term loan to tide over temporary liquidity problem may be fine, but a plan should be there to repay the loan as soon as possible. Now I shall discuss factors with respect to cost of debt. Higher the interest rate, more will be outgo in serving the debt. Secured loans such as mortgages and education loans are relatively cheaper. Unsecured loans such as personal loan and credit card debts are very expensive and must be used with caution. Credit card is an interest-free borrowing option only if repayment is made within due date. When the credit card user does not pay the entire amount, some amount is carried over for payment in the following business cycle. This is called revolving amount. The interest charge on revolving amount are exorbitant, hence revolving credit should be avoided. Finally, some factors with respect to maturity date shall be discussed. Shorter the tenure of the loan, more will be the periodic payment which shall put pressure on available income. Hence, tenure of the loan should be decided keeping in mind the repayment capacity of the borrower. A longer tenure loan translates into higher interest paid over the term. Debt to income ratio can be used as an indicator to decide the periodic repayment amount and tenure of the debt. With this, I complete today's video. Don't forget to subscribe my channel. Please like my video and share as much as possible. Thanks for watching.